This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In this video, I'll be going over the data sets, the earnings, and doing a technical analysis for the SPY for the week of March 23rd, 2026. And I will be releasing a much longer video right after this one. It might be a few hours, but it will be going over the 3 to 6 month trends, basically over the entire market. So I look forward to doing that, and hopefully you all get to see that one. I will be streaming tomorrow morning, so again, I look forward to seeing many of you there. But with that said, let's go ahead and jump straight into the data sets. Now, for the data, we really don't have a whole lot going on this week. We have some revisions coming in from quarter four, but primarily the big day this week is Friday with the Michigan consumer inflation data. Um, let's go over it. So for Monday, there is two data sets. There's the construction spending month over month for January and the Atlanta Fed GDP now. I really don't care about either one of those. I do expect the Atlanta Fed GDP now to start pulling downward even further, since oil prices being elevated does generally lean against your GDP. So we should be seeing the GDP now slightly ticking downward. But for Monday, really nothing remarkable for the market. Now for Tuesday, we do have the ADP weekly change. Nothing really to say about that. Last week it did come in slightly lower, which isn't against our expectations. We really do expect it to basically bounce between that negative 10,000 to positive 10,000. Anywhere between that range is kind of what we expect the market to be seeing right now. Now, we do have some revisions again for quarter four. So we have the non-farm productivity quarter over quarter. Um, the forecast for that is expecting it to pull downward by, 0.4% from the 2.8 to the 2.4%. So that's a cooler data set. Unit labor costs, they are expecting this to go upward for the quarter four. And again, this is just revisions, so not super important. Shouldn't move the market a whole ton, but potentially with that being the primary data sets in the morning, until, of course, 9:45 a.m. That's when we have the S&P global manufacturing data, the composite, the services, PMI, all that good stuff. So that will be what moves the market during the day for Tuesday. Now, there isn't any forecast on these, but we did see the PPI increase slightly. Now, granted, the PMI and the PPI are two different things. Um, but we should be very likely seeing the PMI tick upward very slightly. Um, just currently overall. Now, 2-year no auction, we are seeing the yields pulling upward. Um, Again, oil is really going to be pushing a lot of weight against a lot of our instruments. So treasury yields will be pulling upward in the current cycle. I will be going over that much further in the long video that I'm, posting after this one, going over the, the next 3 to 6 month trends. But in the current cycle, we should be seeing the yields slightly pulling upward. So all of these auctions, the 2-year auction, 5-year, and the 7-year this week, we should be expecting a slight increase in the yield on those. We have Fed Chair Barr speaking, that doesn't matter. For Wednesday, we have the current account for quarter four. Again, just another revision, doesn't matter to me too much. We do have the export and import price index for February. This is fairly important. We have been seeing the imports basically coming in lower and lower and lower. And so that does add to our GDP. Um, with that said, the exports have been going in the opposite direction. So that has been taking away from the GDP. Um, Again, the imports being elevated isn't a good thing. Um, Even though in terms of the overall imports, they're technically pulling back with the imports. So when I mean elevated, I mean the actual just import surplus, I guess. Um, that surplus gets added as a positive to the GDP, which really misaligns what the actual GDP is. Because that doesn't mean that we're not in the position to want to be importing. Um, it's due to the tariff disruptions that have really, um, you know, declined pulled back our imports. So enough about that. I don't really expect a whole lot out of this data. I don't expect it to move the market a whole lot. Now for Thursday, we have the jobless claims at 8:30 a.m. as always. Now we've basically been holding these two levels, the continuing and the initial claims. So the initial claims we've been seeing basically right above that 200,000 added per week. And the continuing jobless claims has really been sitting at that 1.85 million, uh, basically right at that number for the last month. So, do I expect anything to really shift that too much yet? Not really. I do expect oil prices increasing again to start heavily weighing against um, the labor market. So we should be seeing the jobless claims starting to tick upward again. This should be kind of that event that we've been talking about for quite a while now that should, you know, cause some disruption within the labor market. Not that that's something we want, but that's something we've just been expecting. Now for Friday, Friday really is the big day this week, but there really isn't a whole lot to go off of on Friday. So at 8:30 a.m., we have the retail inventories. I don't care about that. That's a nothing data set really. Now, the data that does matter is at 10 a.m. It's all the Michigan inflation and consumer data. So they are, let's see, this is current, so not a revision. The forecast is basically expecting the exact same as prior readings. Um, I don't expect those numbers at all. I expect the sentiment to definitely pull backward. I expect the expectations to pull backward because, again, with oil prices rising, that really starts to scare people. That's one of the first things that starts to rise when inflation is starting to enter back into your economy. So, do I expect the consumer sentiment to be great? No. Do I expect the consumer expectations to be great? No, not at all. I expect those to pull downward slightly. Now, this is going to sound a little backwards. I do expect the 1 year inflation expectations to go upward. Um, the 5 year, I do expect the data makers to push that upward, but in the long end, oil rising usually doesn't cause inflation. And I know many people are going to say, "Oh, you're stupid." That's incorrect. Um, it generally causes a massive deflation in the end of the cycle of that oil volatility. So during the actual oil volatility cycle, yes, you will be seeing inflation entering your market. You will be seeing inflation entering your economy. Your oil prices are, that inflator. It's inflating the price of all of your shipments, all of your trades, just everything. Um, it is the great inflator, okay? However, oil does not stay inflated very long. Generally, oil, when it is inflated, um, it only lasts for a very brief period, whether that period is a few weeks or a few months. It's only a brief period, and then after that, it generally crashes extremely, extremely hard, which generally causes the overall market to start seeing deflationary signs. So, usually, when those massive price crashes happen, we start seeing the Fed start doing QE, a lot of those different really cooling signals. So, it will be a little misleading. A lot of these data sets should be coming in cooler, even though we should, quote unquote, technically be seeing inflation ticking upward. Um, yeah, that's the week's data. Now, the CME and the Fed are starting to price in potential rate hikes. I'm going to say I would almost fully ignore those. We are not in the conditions to be hiking rates. Again, the inflator right now is oil and oil volatility. Nothing other than that. We don't have consumers inflating our prices. We don't have, crazy orders or anything like that, um, causing inflation. So it's inflation out of just pure forced necessity with the oil. Oil disruptions, oil volatility. I'm not worried about long end inflation going up due to this. Again, this should be a massive deflationary thing. I will show the CME and everything, but they will be pricing in rate hikes just because the treasury yields are starting to pull back upward. Um, but I would almost entirely ignore the current rate hike potentials. And very quickly getting into the earnings, we really don't have any major earnings this week. As you can see, there's really nothing on here to worry about. So that's the earnings. Really nothing this week. I want to look at next week though. So nothing next week really. Okay, so we still have a few weeks out before we really start having earnings coming again. So um really about 3 more weeks until we start having major earnings. With that said, I did want to show the Fed CME. So for April, they are starting to price in a rate hike. Again, I would fully ignore this. Yeah, I'm not in that camp at all. I don't expect that. This is the type of environment where they're going to just sit here and pause until the oil volatility ceases to exist. And once that oil volatility starts pulling back, um, you will see these expectations drastically shift in the other direction. So, I'm not on this camp at all. I'm not seeing this happening at all. Our current rate is at the 350 or the 3.5 to the 3.75%. For December of 2026, they are expecting, a 0.25% uh, rate hike by 26.5%. We can see that start to climb as oil volatility and oil prices again do lead to a lot of conditions that you would want to usually rate hike, but with the conditions of the economy, market, and just previous events do tell us that this is absolutely incorrect, and it's extremely likely we head in the opposite direction. So that's what I wanted to show with the earnings and the CME. Really nothing too big this week.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And getting into the technical analysis, as always, let's ensure our daily time frame is turned on and our moving averages and Bollinger Bands. Now, I'm going to be going over the long trend in a different video. Again, I will be releasing that later tonight. However, I will kind of go over what I'm expecting out of the rest of this week. So, last week we had some selling start to occur, and it actually hit that 646 range that I talked about for over a month now. It's actually surprising that they pushed that hard on Friday. I did not expect it, but we ended up making quite a lot of money off of that move anyway. With that said, on Thursday, they rejected the lower Bollinger. So many were saying, was that the lower Bollinger day one? No, that was not the lower Bollinger day one, unfortunately. That was a rejection, which is why I was originally expecting the potential move up to that 5 mile. However, we had a major selling day on Friday, which means that we did finally see the lower Bollinger day one um, secured. And with that being secured, that means that the extreme likelihood is that we're going to be seeing a lower low um, come Monday. I do have some puts for that position, and any of the current cycle puts, you should be trying to, well, again, on financial advice, you should be trying to exit those puts within that day two bottom Bollinger lower low. That's what I will be looking for tomorrow. And from that position, what I will be looking for again is the slow pullback up to the 5 mile range. Now, this happened basically a week ago, and we talked about this exact same move where from that lower Bollinger, we take calls and we ride those calls back up to the 5 mile. Now, we talked about how this could potentially go up to the 20 mile, but the real exit was going to be at that 5 mile range. We took that exit, at least hopefully people that were following me took that exit. And from that exit, we started positioning for the downside again. Because that's how you play this current market. Again, with us being so heavily pushed below this 50 mile range, I do consider us starting to enter into a major bear market. Now, again, many people might disagree with that, but I'll show why I will, further believe that will be coming pretty soon here. With that said, the expectation for Monday should be that lower low from the bottom Bollinger Day 2. From that lower low, we should see the consolidation back up to the 5 mile. Now, last time they did this happened all within a single session. Okay. That's generally not what happens. Usually it takes about 2 to 3 sessions to see that consolidation back up to that 5 mile level. However, from that 5 mile, we can start pushing back downward again. However, and I can't really show it to you in the drawings right now because I have so many drawings from the actual just live streams. It would be a mess. But I want you to follow my cursor with me for a moment and go ahead and start following. We had this movement right in this range. Okay, and this was two lower Bollinger moves. And these were two successful lower Bollinger moves. That is something that's not very common, but not only is it not common, it also triggers a condition that is also not common. Um, we have not tested the 20 mod to the upside in roughly a little under a month. That last 20 mod test really didn't hit that level very well. So yeah, about a month now. So we're very much due to start hitting this 20 mod range again. So from this lower Bollinger, and I'm going to call this the second lower Bollinger move because the first one was in here. We did have another lower Bollinger move in here, but I don't want to count this towards this push. But basically this is going to be that second major lower Bollinger move. And from that second lower Bollinger move, the expectation to the upside should be to start consolidating back up to that 20 mile. Now currently the 20 mile is at the 673.92. However, this will be aggressively pulling down each and every session as we start to consolidate back up to that range. So the expectation should be a lot close to that 664 range. Um, Again, that's going to align a lot with where the 10 mile is currently. Um, Sorry, I'm just taking a look at this. Yeah, that's what we should be looking for. So the calls from the lower Bollinger Day 2 here should take us to that 20 mile range. Now, from that 20 mile range, this is kind of where the major test will happen. Either we're going to see the upside push to the upper Bollinger again and the bear market is canceled, or we're going to see the rejection from the 20 mile, which that's almost 100% what I'm expecting. I'm expecting us to pull up towards that 20 mile range, have a major rejection, and start pushing down for further downside. Now, I'm going to show the SPACs for a moment because there is an important drawing that I have set up on there, and that is measured moves. Okay, now how measured moves generally work, and I do want to turn off the Bollingers and everything for a moment, is that usually with measured moves, whether it's buying or selling, is that you generally see the same type of movement go each direction. So if you're going to see a very large measured move to the upside, usually you're going to see some form of selling to complete that move to the downside. Now, a very, very quick example of this is within this range. We have the move to the downside, and from that downside move, we have it entirely filled up to the upside. Okay, so this is an extreme measured move right here, and this is also a bullish structure. Okay, so the yellow is the bullish structures, purple is the bearish structures, the red is when the structure breaks and basically changes direction and starts turning into a new structure. Again, with the daily time frame, these structures hold a ton of weight. Now, we're going to take a step back here, and we're really going to start basically January 1st of 2025. Okay. So a whole year ago. A year and some months ago anyway. So start of 2025, we were within this very large bullish structure. Okay, and this bullish structure was a cup and handle. Now, we started selling, 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 and from this selling, we created a large inverse cup. Now, from this inverse cup, we potentially were creating the bottom of that inverse cup, which we would expect bullish structure. And I'm just going to label this just so that it is easily shown here. And from this structure, we would expect basically to start pulling up and head back down. Okay, that did not happen. So this is not an inverse cup. Okay, this was a bullish cup and handle. We have the structured cup, the bullish handle, and the breakout. Okay, so this was a bullish structure. From that bullish structure, we start seeing a little bit of consolidation, potentially start forming a smaller inverse cup. We do not see the handle. We see a breakout within this cup, this inverse cup and handle. So this changes direction, forms more bullish structure, says, okay, we're going to start pushing upward even further. From that push upward even further, we start creating this potential head and shoulders, or could even be looked at as another inverse cup, potentially forming that inverse handle to the downside. That was again rejected, invalidated with the red structure here. And with that invalidation, we start heading to build bull structure again. Well, this was basically at mid-December. I don't want to say mid-December. It really started at the beginning of December. Um, we started seeing this major cup take form, saw the handle, was looking for the breakout within the handle, and this was back when everyone was calling me, the perma bull, because I kept saying, okay, we're going to get ready to push up to the upper Bollinger. We're going to get ready to start seeing that 700 plus range and all-time highs. We did not see that. We started to see rejections. And from those rejections, we started to see further bearish structure. We see this inverse cup and handle slash double top taking us even further downward. We're seeing inverse cups closing, inverse cups closing, inverse cups closing. Okay. Now we've completed some major structures. We have now completed a major inverse cup, and now the next measured major moves are basically telling us that we should pull upward, and from pulling upward, we should start heading downward. Okay. Now, what does this create? This creates a head and shoulders. Okay. Now, a head and shoulders on the daily time frame within this type of structure, breaking previous bullish structure, which again, if we start breaking the top of this previous cup, this is telling us almost exactly that we are getting ready to go from the top of this channel to the very bottom. Okay. Now, this is going to take some time and this is going to be covered a lot further in my longer form video. However, this should really be the expectation. Um, moving into the spring, moving into summer, and starting entering into the fall. Um, this is aligning extremely, extremely, extremely well. And the bullish push up from here to retest that 20-mile range aligns perfectly with this measured move, which is right in here. The downside from this measured move is taking out this previous bullish structure. Okay, so potentially we have some major downside. Okay, correlating this to the actual SPY, that puts us a lot closer to that 50 or 550 range. So is our downside massive? Absolutely. We will be targeting that, and that is, excuse me, that's kind of the overall goal. Is that we want to set up some very long dated puts. Now, my target for those long dated puts are going to be at this 20-mile range. If we see this 20-mile range break out, then all we have to do is close those long dated puts or hedge against them. Because if we get the breakout of the 20-mile to the upside, that's telling you that very, very likely we're going to start seeing our moving averages and price action pull back upward. However, I'm not expecting that. I'm expecting to pull back up to the 5-mile, see the retest back up to the 20-mile, and this will catch, again, the majority of the market off guard. And that's what you have to do during bear markets. And I want to show an example of this back in 2022. It's back in here. And you know it's back in here because it's very choppy. Well, why does the market chop in here? And this is extremely important question that is partially rhetorical, but partially not. Okay, because I'm going to answer it. Why does the market chop? It is so that they can sell calls. And by they, I mean the dealers. I'm marking all the lower Bollinger moves here to the 20-mile range. So something I want you to pay attention to here is how many of these moves within this bear market, and again, this is almost the entirety of 2022 into 2023. How many of these moves pull above the 20-mile into the upper Bollinger? So let's see. That doesn't happen there. Does not happen there. We do not see the lower Bollinger triggered there. This is the only time we see upper Bollinger. Well, maybe not the only time. I think there's one other time. But we're going to mark that in green. Now we'll mark that in white because I want to see that clearly. And let's see another time. Another time above the 20-mile in here, which again, this was not a lower Bollinger move. So bear markets are all about selling calls. Okay. Now, as a dealer, when we sell calls, that means that we are trying to sell a position to where a bull will buy that call, thinking they're going to get the upside for it to burn and run to zero, because that's how I'm going to make my premium. Okay. During a bear market, if I bought in at the absolute top here, which dealers will be buying at the absolute top of these markets, how do I protect my downside? I ride puts. Okay, I simply just ride puts on the downside. How do I make money during a bear market though? Again, I have to use my equities. Okay, so I have to sell calls. I have to sell calls that are going to burn. Each one of these candles in here burns out. All the calls sold at that 20-mile range burned. Burned. And we'll just go through all these because this is very important to understand how bear markets function. Burned. these calls slightly not entirely burned in here. But still a large majority of these calls do get sold and burned. Burned, burned. Sorry, this is a very, very key point. Okay. Burned. So during the entire bear market, okay, during this entire bear market, which basically lasted about, I believe it was 15 months if I remember it correctly. During this 15 months, there was only two real bullish moves in here. Okay. That significantly pushed above that 20 mile range. Other than that, um, we went to the lower Bollinger, bought up to the 20 mile, sold that off to the lower Bollinger, back up to the 20 mile, sold that off, back up to the 20 mile. A little bit of buying in here. Again, I don't remember what events were going on. This could have been data driven. This could have been positive sentiment. A lot of different reasons could have shown that push to the upside. Um, but once again, massive sell off. Didn't even give the bulls the upper Bollinger there before entirely selling them down. Um, geez, they sold them basically $60, $70 off at that point within a few weeks. Um, so hopefully this is making some correlations. Yes, we'll do that later. Um, okay. So hopefully that point gets across of how bear markets function. The bear market isn't intended to sell puts. It isn't intended to create growth. Okay, the whole point of a bear market is to protect your equity buy while selling calls to make profit. And it's extremely likely we're going to be seeing that exact same type of pattern um, happening up here. Again, my drawings are a little messy. Do apologize. But we're seeing that exact same pattern starting to occur. Down to the lower Bollinger, up to the 20 mile, rejection back to the lower Bollinger, pull back up, don't even get to the 20 mile at that point, pull back down to the lower Bollinger, very likely pull up to the 20 mile, and from that 20 mile, extremely likely to continue rejecting downward. Final thing I want to add with this post, or with this video, is that the daily ADL has been absolutely terrible. Okay. Um, we're within a major selling trend here. Don't just assume that this is going to be bought up like the major dip we had in April. Um, the conditions are entirely different. Okay. I do believe we're going to be seeing this, quote unquote bear market taking us well below the 600 level. Okay. So again, the goal, set up some very nice puts at the 20 mile range that are dated out and take that downside. That's the entire goal of the bear market. Set up puts at the 20 mile, take the downside. Set up puts at the 20 mile, take the downside. Rinse, repeat until the sentiment starts changing into more of a growth sentiment. Okay. So yeah, I think we covered everything with this video. Bottom Bollinger Day 2 on Monday. From that bottom Bollinger Day 2, the upside should be anticipated and expected. From that upside expectation, we should be seeing the 5 mile at least. From the 5 mile, we will be watching our volatility instruments and other, technicals and everything to see if we're going to start pulling up towards that 20 mile. With the 20 mile pulling downward each and every session, I am expecting it to be a lot closer towards that 664, 668 range before it's tested. So we do have quite a bit of upside. So again, tomorrow, Monday, I will be buying some long dated calls to ride that upside to the 20 mile. And then once we get to the 20 mile, those calls are going to be cut off. and I'll be riding the downside premium towards the bottom Bollinger again. So that's the plan, everybody. I hope we have a great week. I hope you can join me in the morning stream. Just a reminder, I will be making another video. It is starting to get late, so I don't know if it'll be coming out tonight. It might be coming out tomorrow. But I do want to make a very long dated video or a very long term video where it's going to be covering basically the trend for the next 3 to 6 months. And it should very accurately cover that trend. It's I've spent the entire weekend going over each and every one of those symbols, so we should be seeing those trends hit almost to the penny. So, with that said, have a great night, have a great day. I hope you join me in the morning stream. Again, I'll be streaming Monday, Wednesday, and Friday this week. Um, yeah, thanks for watching. Have a great day, have a great night. Trade safe, everybody, and I will talk to you in the next video. Take care.